Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 126, and in this episode we are reviewing the performance of the global markets during the 38th week of 2024, and that is from Monday the 16th to Friday the 20th of September. And without further ado, this is your host Jamhuri, and together let's dive right in. We kick it off in the United States, where on Wednesday the Federal Reserve effected its first interest rate cut in 3.5 years, slicing off 50 basis points from its benchmark rate in an effort to reverse the slowdown in the U.S. labor market. Apart from the emergency rate cuts implemented during the COVID pandemic, this was the first time that the Federal Reserve has cut rates by 50 basis points since the global financial crisis in 2008. With both inflation and employment softening, the Federal Open Market Committee decided to reduce its overnight borrowing rate by 50 basis points, which now lowers the Fed funds rate to a range of between 4.75% and 5%. The Fed funds rate provides the basis for the cost of short-term borrowing between commercial banks and also influences the cost of various consumer products such as credit cards and mortgages. As the Federal Reserve implemented its first interest rate cut since the COVID pandemic, billionaire investor Ray Dalio flagged that the U.S. economy still faces the risk of an enormous amount of debt. The founder of Bridgewater Associates said that the challenge for the Federal Reserve is to keep interest rates high enough for investors, but also low enough so that they are not problematic for the U.S. Treasury. The Treasury Department recently reported that the U.S. government has spent more than $1 trillion so far this year on interest payments for its national debt, which is estimated at $35.3 trillion. And this increase in debt service cost is further compounded by a significant rise in the U.S. budget deficit, which is now approaching $2 trillion for the current fiscal year. The implication of the Fed's decision to cut its monetary policy rate is not limited to the United States, but will be felt around the world. Case in point is emerging market countries like Kenya, whose external debt is predominantly in US dollars, and therefore, as the Fed cuts interest rates, this in turn should hopefully reduce the cost of borrowing and debt servicing for emerging market countries. And across the pond to the United Kingdom, even after the Federal Reserve opted for a massive rate cut the day before, the Bank of England stood its ground on Thursday and decided to hold its benchmark interest rate steady following its initial rate cut in the month of August. The Monetary Policy Committee voted 8-1, with the dissenting member voting for another 25 basis point rate reduction. The committee said that a gradual approach to monetary easing remained appropriate as services inflation remained elevated. Whilst headline inflation was moving consistently towards the 2% target rate, the UK economy continues to record sluggish growth and is expected to return to an underlying growth of around 0.3% per quarter in the second half of 2024. And staying in the United Kingdom, the day before the Bank of England decided to hold rates steady, the Office for National Statistics released data showing that inflation in the UK held steady during the month of August. The headline Consumer Price Index came out in line with the previous July reading of 2.2%, but was a tad bit higher than the headline number for May and June, which was recorded at 2%, which was in line with the Bank of England's target rate for inflation. The services sector, which accounts for around 80% of the UK economy, saw inflation ticking higher to 5.6% in August, up from 5.2% in July. Meanwhile, core inflation, which excludes volatile food and energy prices, this came in at 3.6%, up from 3.3% that was recorded in July. On Wall Street this past week, the Dow Jones Industrial Average closed at a record high on Friday after a massive rally during the week that was triggered by a 50 basis point rate cut by the Federal Reserve. The reduction in rates saw investors shift their focus from bonds into equities as shares are bound to benefit from lower interest rates. On Thursday, the Dow hit a new record high above 42,000, whilst the S&P broke above 5,700, and on Friday, the 30-stock Dow inched up by 38 points for a new closing high of 42,063, while the S&P 500 pulled back slightly by about 0.2% to close the day at 5,702, and the Nasdaq Composite dropped by 0.36% to end the week at 17,948. For the week, all the three major indices were in positive territory as the S&P 500 rose by 1.36%, while the Dow was higher by 1.62%, and the tech-heavy Nasdaq advanced by 1.49%. In the government bond market, U.S. Treasury bond yields ended the week on a higher note, even after the Federal Reserve delivered a massive rate cut earlier in the week. The Federal Reserve's decision to slash interest rates by 50 basis points comes in the same week when other major central banks, such as the Bank of England, the Bank of Japan, and the People's Bank of China, decided to keep interest rates on hold for the time being. For the week, despite the 50 basis point rate cut, the yield on the benchmark 10-year Treasury bond still managed to close higher by almost 8 basis points and was last seen trading at 3.73%. Meanwhile, the yield on the policy-sensitive 2-year Treasury note fell by around 2 basis points to settle at 3.58%. For your information, bond yields and prices move in opposite directions, and 1 basis point is equivalent to 0.01%. In the commodity markets, the price of crude oil took a dip on Friday, but still managed to record a second straight week of gains as it garnered support from a reduction in dollar interest rates, but was held back by signs of a slowing economy in China. Oil prices have since recovered from last week's drop when Brent crude fell below $69 for the first time in nearly 3 years. The current view is that oil prices below $70 could only be justified during a global recession, and the massive rate cut in U.S. interest rates has greatly reduced the risk of that happening. For the week, both benchmarks were up by more than 4%, with Brent crude trading at $74.49 a barrel, whilst the U.S. benchmark West Texas Intermediate was priced at $71.92 per barrel. In the precious metals market, for the first time ever, the price of gold broke above $2,600 on Friday to extend a rally that was boosted by expectations for further rate cuts as well as escalating tensions in the Middle East. Bullion's latest rally received a boost after the Federal Reserve announced an aggressive 50 basis point rate cut on Wednesday, which increased the appeal for this non-yielding asset. The price of gold has so far risen by 26% in 2024, which is its largest annual increase since 2010, as investors seek out safe haven assets to hedge against geopolitical risks such as the escalating conflicts in the Middle East and Ukraine. The price of spot gold eventually came to a close at $2,593 per ounce. In the cryptocurrency market, cryptocurrencies rallied on Thursday after the Federal Reserve delivered a 50 basis point rate cut on Wednesday. The rally in cryptocurrencies was part of a broad market rally that saw risk assets such as stocks initially rise sharply before pulling back slightly as traders absorbed the news. According to market analysts, Bitcoin continues to display a tight correlation with growth in money supply and, as expected, a negative correlation with the US dollar. For your information, Bitcoin behaves as both a hedge and a risk asset and is currently more closely correlated to the Nasdaq Composite than it is with gold. According to CoinMatrix, the crypto rally was well underway before the Fed's decision, and for the week, Bitcoin was up by 5.5% and was last seen trading at $63,255 per coin. We now change scene to the Kenyan financial markets, and we start by looking at the domestic foreign exchange market, where during the past week, the Kenya shilling remained extremely stable versus the US dollar. And according to data obtained from the Central Bank of Kenya website, the official exchange rate for the US dollar was quoted at 129.20 compared to 129.18 the previous week. However, in the interbank market, commercial banks were selling the US dollar within a range of between 131 to 133 shillings, and the lowest rate was quoted at 131.45 and was offered by Stanbic Bank, whilst the highest rate was offered by NCBA Bank at 132.50. Meanwhile, the sterling pound was priced at 171.22 and the euro was valued at 143.90. And on the regional front, one Kenyan shilling was changing hands for 28.79 Ugandan shillings, and 21.09 Tanzanian shillings, and to the Rwandese franc, it was posted at 10.38. Over the past 6 months, the shilling has been relatively stable against the US dollar. However, that does not negate the fact that Kenya's underlying economic fundamentals remain extremely weak. And this is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. Despite its relative stability, the shilling remains vulnerable to external shocks, such as an increase in oil prices due to the escalating conflict in the Middle East. Kenya needs to contain its uptake of additional sovereign debt in order to avoid falling into default, which could send the country into an economic tailspin that will take decades to unravel. On foreign exchange reserves, Kenya's usable foreign exchange reserves increased for the second week in a row and was up by a significant amount of $112 million to hit $7.85 billion, which is equivalent to 4.1 months of import cover. This level of reserves is now in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by an unsustainable external debt that has pushed the country to the precipice of a sovereign debt default. On diaspora remittances, the inflow of remittances in the month of August 2024 totaled to $427 million, and this is compared to $354 million in August 2023, which was an increase of about 20%. The cumulative inflows for the 12 months to August 2024 increased to $4.645 billion compared to $4.120 billion for a similar period in 2023, which was an increase of about 13%. The inflow of remittances continues to support the country's current account as well as the domestic foreign exchange market. The United States remains the largest source of remittances into Kenya, accounting for about 56% of the total remittances that were received in the month of August 2024. In the money markets, during the past week, the liquidity situation in the interbank market remained sufficiently adequate and was also supported through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and credit in the economy. The interbank rate, which is the rate that banks lend to each other on an overnight basis, this increased marginally by just 4 basis points to 12.70%, and this was up from 12.66% that was recorded the previous week. And in terms of volume, the average value that was traded in the interbank market decreased to 26.7 billion shillings, down from 34.2 billion shillings the previous week. Meanwhile, the excess reserves held by commercial banks in relation to the 4.25% cash reserve requirement, this stood at 11.9 billion shillings. For your information, the cash reserve is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 19th of September, and the central bank received bids totaling 30.3 billion shillings. against an advertised amount of 24 billion shillings, representing a performance rate of about 126%. The central bank ended up accepting 25.5 billion shillings, and the results of the auction were as follows. All the three tenors were marginally lower by less than 1 basis point, with the 91-day rate at 15.74%, whilst the 182-day rate came out at 16.61%, and the 364-day rate was flat at 16.81%. In the primary bond market, the auction for the September bond issue was held on Wednesday, the 18th of September, and the central bank received bids totaling 22.6 billion shillings against an advertised amount of 30 billion shillings, representing a performance rate of about 75%. The central bank ended up accepting 19.2 billion shillings, and the results of the auction were as follows. The first bond was a 10-year bond with 9.5 years left to maturity, and the central bank accepted 11.5 billion shillings at a weighted average rate of 16.86% compared to the bond's coupon rate at 16% flat. The second bond was a 20-year bond with 12 years left to maturity. The central bank accepted 7.7 billion shillings at a weighted average rate of 17.28%, and this is compared to the bond's coupon rate at 14% flat. In the international market, during the week, the yields on Kenya's Eurobonds were on a downward trajectory, decreasing by an average of about 78 basis points, with the yield on the 7-year 2019 Eurobond decreasing the most by 1.4 percentage points, as it fell from 10.5% recorded the previous week to 9.1%. At the Nairobi Securities Exchange, during the week, the equities market was on an upward trajectory, with the NSE 20 gaining the most by 4.5%, whilst the NSE 25, the NSE 10, and the NASI gained by 0.4%, 0.3%, and 0.1% respectively. This takes the year-to-date performance to gains of 21.5% for the NSE 10, 20.1% for the NSE 25, 18.7% for the NSE 20, and 15.7% for the NASI. The market's performance was driven by gains recorded by large-cap stocks such as KCB Group, DTB Bank, and NCBA Bank, which increased by 4.5%, 2.4%, and 1.9% respectively. This performance was however weighed down by losses recorded by other large-cap stocks such as Standard Chartered Bank, Stanbic Bank, and Equity Group, which declined by 3.4%, 3.3%, and 2.8% respectively. In the domestic headlines this past week, the latest data from the Central Bank of Kenya shows that the government's overdraft facility increased by more than 20 billion shillings during the past week to stand at slightly above 70 billion shillings. The Treasury confirmed that it had utilized the facility to finance coupon payments that were due to bondholders. For your information, the Treasury utilizes the overdraft facility to finance short-term requirements in the event of cash flow challenges. And in other news, the value of claims made for pending bills under the ongoing verification exercise has increased by 2.4 billion shillings and is now estimated at 665 billion shillings, with over 114,000 claimants. This information was disclosed by the National Treasury and comes ahead of an interim report by the pending Bills Verification Committee that is due to be released next month. Up next is our topical issue, and this week we are looking at the delayed approval of IMF funding for Kenya. The International Monetary Fund has further delayed the approval of new funding to Kenya and said that this was due to a lack of consensus on the new revenue targets following the withdrawal of the finance bill for 2024. The fund was widely expected to approve the disbursement of at least $600 million in September, but the lender has yet to set a date for that approval. The withdrawal of the 2024 finance bill, along with missed tax revenue targets, has forced both parties into fresh talks, which are aimed at setting new revenue targets as part of the loan conditions. The IMF conducted a new staff visit from the 11th to the 16th of September and held discussions with Kenyan authorities on recent developments and the policies required to address emerging challenges. The Central Bank of Kenya said that they expected a total disbursement of about $1.4 billion for the remainder of the program, which runs until April 2025. And just last month, the central bank governor indicated that he expected the IMF board to ratify the next disbursement of about $600 million, given that Kenya had met most of the quantitative performance criteria under the program. However, the withdrawal of the Finance Bill 2024 has denied the government an estimated 344 billion shillings in additional revenue, and in the process delayed the approval of the next disbursement from the International Monetary Fund. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please share it with a friend and help to spread the word around. I really do appreciate your assistance in this effort. And for your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcasts, Spotify, and Amazon Music. Please consider subscribing so that you can be notified every time I publish a new episode. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamuhuri@gmail.com. Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, the hardest line to cross is the starting line. Think about it. Thank you, and God bless.